Good afternoon. Good afternoon and welcome to the 2018 Magellan Advisor Roadshow. My name is Mark Jordan, and on behalf of everyone at Magellan, thank you for taking the time out of your busy day to join us, and thank you for the ongoing support that you provide to Magellan. We really do appreciate the relationship that we have with the advisor community, and we don't take it for granted. Welcome also to those that have joined us via a live stream, so people from around Australia, welcome to you, and also a warm welcome to our guests representing various media organisations here today. On to today's agenda. I know that many of you are regular attendees to the Magellan Roadshows, and over the past couple of years, you will recall that Hamish Douglass has spoken a lot about technology and some of the new technologies that are shaping the future. Artificial intelligence, machine learning, driverless cars, things that we think a lot about and think that will shape businesses into the future. We have received some feedback from you that this year, given what's going on in the world, you would like Hamish to spend more time focusing on the portfolio and some global macro issues. So we've taken that feedback on board. We've listened to what you're looking for, and today Hamish will put much greater emphasis on the global strategy. We'll open up with a short video. Then on stage, Magellan's chairman, CIO and lead portfolio manager Hamish Douglass will take to the stage. Following Hamish's presentation, we do have a special guest whom Hamish will introduce at that time. Given the time limitations today, we won't be able to open to the floor for questions, but if you do have questions that you would like answered, please put them down on your feedback forms. We'll certainly consider all of those, and in the next couple of weeks we'll actually launch a video that Hamish will record to address the most common questions that you've asked. And obviously the Magellan distribution team is more than happy to follow up with those as well. We hope you enjoyed the presentation today. Let's roll the video.
From this day forward, it's going to be only America first.
This was the largest audience to ever witness an inauguration, period, both in person and around the globe.
Sean Spicer, our press secretary, gave alternative facts to that. But the point remains.
Wait a minute. Alternative facts? Look, alternative facts are not facts. They're falsehoods.
I want you all to know that we are fighting the fake news. It's fake, phony, fake. A few days ago, I called the fake news the enemy of the people, and they are. They are the enemy of the people. Because they have no sources, they just make them up when there are none. I always say it, if I would have ever said that shortly after winning we're going to hit 4.1, those people back there would have said, this guy, no good. Fake news. Fake news. How fake are they? Fake news and the Russian witch hunt. We got a whole big combination. Where is the collusion? You know, they're still looking for collusion. Where is the collusion? Find some collusion.
Well, thank you very much for everyone turning out en masse in Sydney. I think this must be the biggest gathering of advisors that Sydney has ever seen. I actually don't know if that's true or not, but I thought I'd say it anyway. Today, what I'm going to talk about is I'm going to run through, on the back of Trump, I'm going to run through a little bit of fake news of our own, and then I want to get into some of the big macro threats that we're seeing as a fund manager at the moment. And many of these actually have Trump at the centre of these threats that we're seeing at the moment. Then I'm going to try and give a bit of an update about how we're trying to manage those risks at the moment in the context of the portfolio. And at the end of today, I'm going to ask up a very special guest. And this guest is actually a consultant to Magellan who's been working with us over the last 18 months or so. And I think you'll find that person gives tremendous insight to some of the big issues we're witnessing at the moment. So let's start with a little bit of fake news. Here we have a tweet from Amy Stake saying that US stocks are overpriced. And I must admit, we hear this a lot. You probably hear it a lot. It's a lot in the media. It's pushed a lot by competitors. I'm not arguing in any way that US stock market is cheap. I'm actually really not arguing nearly any stock markets around the world are cheap at the moment. But is it really the case that similar companies, if they're listed in the United States, are going to be expensive, and then companies outside of the United States that would be similar in nature would be cheap? So let's look at some of the facts on this at the moment. This chart is trying to show, or it is showing, the 5 largest consumer staple businesses that are listed in the United States of America. And you can see that they're trading at around 18.4 times this year's coming earnings. Actually, we've owned all of those consumer staples in our portfolio over the years. We own Kraft Heinz at the moment. Now let's look outside of the United States at the moment, and these are the 5 largest consumer staple businesses excluding China. We've owned many of them. We're owning Nestle. They're trading at around 20.9 times earnings on average, that group. So we hold 2 outside the United States, Nestle and a company called Reckitt Benckiser in the UK, and we own Kraft. And as we search around the world, if we're looking in our franchise group and we're looking at consumer staples, we don't find any evidence that it's all expensive in the United States and miraculously cheap somewhere else in that sector. Now let's move on to technology. Here we have the 5 largest technology firms that are listed in the United States: Apple, Alphabet, Microsoft, Facebook and Visa. Anyone who's followed us has probably noted we own all of those stocks at the moment. They're trading on average at 21.5 times earnings. Let's now move outside the United States, and the 5 largest technology businesses that are listed outside the US. The 2 big Chinese companies, Alibaba and Tencent, both platform companies. They don't look any cheaper on a PE multiple basis and their big counterparts in the United States. Samsung does look a lot cheaper than the others, but it is really a commodity-related business. It's a memory chip business and a phone handset business that doesn't actually own its operating system, so very different in nature. And we actually own SAP, large enterprise software business listed in Germany. If we go to the healthcare sector, the 5 largest healthcare companies listed in the United States, 15.2 times earnings. We don't actually own any of those stocks at the moment. We do own a large healthcare business in the United States, the largest hospital operator, HCA. It's trading at around 13 times earnings at the moment, and that's actually after its stock price is up 50% in the last 12 months or so. Now let's look outside the United States. On average, they're trading at around 14 times, actually pulled down by Bayer, that's the German group that bought Monsanto, that's under pressure at the moment because of the litigation that's going on there. We own Novartis out of that group. And if we look at the banks, the 5 largest banks in the United States, you can see they're trading at 11.2 times earnings. We actually own Wells Fargo. We would have been better at holding any other bank in the United States other than Wells Fargo in the last 12 months or so we certainly don't get it right all of the time. And if we move to the 5 largest banks excluding China outside the United States, they're trading at 11.2 times earnings. We own one US bank and one non-US bank. I'm actually not very bullish on the long-term outlook for banks around the world. We could get into that another day. So at the end of the day, we're not finding as a global manager in the sectors that we cover when we're looking for a portfolio of outstanding businesses around the world, we're not actually finding there's a lot of evidence that suddenly outside the United States to inside of the United States is the area you would distinguish in terms of pricing. We'll actually buy any company in our viewpoint of what's an outstanding business. We're agnostic to where it's listed, but we're not agnostic to value at the end of the day. What do we have now? We have Amy, what she got here. Magellan Global Fund has not delivered. That's certainly fake news. Let's actually have a look at the facts here. We have to start with what we're trying to achieve at Magellan, and these objectives have not changed at all over the last 11 years. The first objective we have is to generate people an acceptable return on their capital. It isn't an objective to outperform the MSCI over the next 6 months, or the next 12 months, or the next 24 months. We've set a long-term objective of 9% per annum net of all fees through the investment cycle, and we've got a second objective, which is don't lose money, as in preserve capital on the downside. When markets get difficult, we want to have materially lower downside performance in those down markets, and nothing has changed about what we've been doing over 11 years. So the first question we have to ask ourselves is, have we actually achieved a 9% per annum target? We would argue 9% per annum over the longer term, if you achieve it, is probably going to beat any long-term market index, one of the reasons we set the objective when we thought about it. And the second thing you need to think about is a lot of people, when they measure performance, either look at the wrong periods or will look at just a snapshot in time. We think you have to look at a minimum of 3-year period in measuring performance. I think any shorter period than that, it's just meaningless. And then at the end of the day, I think a lot of people may look on the 30th of June and the 31st of December, and they'll measure performance over that period. Believe it or not, that is a picture on 2 days of the year only. That doesn't tell you how they would perform in August or September or November or January or February. It's just 2 days of the year. And we've actually seen often we could have performance on the 30th of June that we may be outperforming or underperforming on a 3-year basis, but literally 4 days later, the figures could be 100 to 200 basis points per annum difference a few days later than that. So it's very important, we think, you look at rolling returns, that you look at returns measured each month over 3-year periods. So what I'm going to show you is what we call let's watch the movie. Instead of just watching one picture, let's look at all the 3-year rolling returns. There's 100 months. So here we go. This is look at the 9% per annum over the 100 monthly periods that will give you a 3-year return series. So there's a 9% target. Early on, we were underperforming the 9%, not surprising. Markets fell by 50% not long after we set the strategy up. Then we're outperforming, coming off the back of the very low markets, not surprisingly. Through the whole series, we've performed at around 12.2% per annum net of all our fees. That's close to 6% per annum above what the markets did over the same period of time. We've actually outperformed the 9% per annum 3/4 of the time since we set it up, and that included the initial period after the collapse in markets in 08, 09. The next thing in the objectives was downside performance. This chart is actually all the players who Morningstar cover. I think there's 85 managers in the global equity universe covered by Morningstar and published here in Australia. The red bar is showing any 3-month period where the market has gone down. So we're picking every quarter, and they're rolling quarters, where the market, the MSCI, has had a negative return. If you're in the red bar, it means on average through all those quarters, the manager has gone down more than the market. And the green bar shows managers who have gone down less than the market when the market in a quarterly period has had a down period. Believe it or not, it's very evenly split here. 52% of managers covered by Morningstar have gone down more than the market, and 48% of managers have gone down less than the market. It's very interesting if you go to the right-hand side of this chart and we start looking at managers that have got materially lower downside participation when markets are negative. If we say that people only have 75% of the downside of the market, so the market goes down 10%, those managers have gone down by 7.5 or less than the markets. There's only actually 4 managers who have gone down less than 75% of the market's downside over the last 11 and a bit years. So let's have a look who they are. They're actually Walter Scott out of the United States, IFP out of the UK, Packer & Co is actually a group out of Perth. They don't run a pure global equity strategy. I'm not sure why they're in the universe, but we're not trying to edit the universe here. And then the Magellan Global Fund has actually had the best downside protection of any manager covered by global equity manager covered by Morningstar over the last 11 years, and we've had a ratio of around 0.5. And given there's only 4 managers less than 0.75, it's quite a difference compared to most of what managers have experienced. The next thing I want to do is how do we actually compare, and this is really consistency of our performance relative to the market and the amount of excess returns generated above the index. So the horizontal line is actually consistency of outperformance. So if you're above 50%, it says on a 3-year rolling basis, you're outperforming the market more than 50% of the time. And if you look on the vertical axis, it's showing the level of excess return. So if you're above 0, on average over 3 years, you've delivered a return more than the market or the MSCI index. Clearly, you'd want to be in the green box here. You'd want to be outperforming the index more than 50% of the time, and you'd want to be adding value above the index. I'm not sure you'd want to be advertising you're in the red box here. That means you're underperforming more than 50% of the time, and you're delivering an investment outcome on a 3-year rolling basis less than the passive index you could buy through the MSCI. What I'm now going to do is plot, but not name, what the 85 managers have managed to deliver over the last 11 years. This is not a good advertisement for active funds management. I imagine Vanguard will steal this chart and use it in the future. If you're looking for managers who've outperformed the market more than 50% of the time, and you know, if you're employing a fund manager and you want to report to your clients, I guess you'd want your managers to be outperforming that index more than 50% of the time. So 1 in 2 conversations with your clients at least would be positive. There's only 33% of managers who have outperformed the MSCI more than 50% of time. And then the second one we could say is how many managers have outperformed the MSCI by more than 1% per annum on a 3-year rolling basis. 1% per annum. There are only 16% of managers who have outperformed the index by more than 1% per annum. Vanguard's got to love this. I'm going to circle a group of managers here, and these are managers who have outperformed on a 3-year rolling basis more than 75% of the time on a 3-year rolling basis and delivered alpha of at least 1% per annum. You're probably all saying that that's what we want all our managers to do. Believe it or not, there are only 5 managers who have managed to do that over the last 11 years. We will show you this time who they are, only because we're in the group. There are 3 managers who have outperformed the market more than 90% of the time on a 3-year rolling basis. It's MFS, Arrow Street and Magellan. And there are only 2 managers who have delivered more than 300 basis points of excess return. And they're ourselves and IFP over the last 11 years. At the end of the day, I'm very, very proud of our investment team and our analytical team. They've done an incredibly good job. I'm just the puppet at the top of this thing who relies on incredibly good analysis. But we've got a very, very disciplined process about what we're trying to do and what we're aiming at, with very clear investment objectives. And I really think it's been consistent delivery. And there are periods in time measured in snapshots where, of course, we are going to underperform the MSCI index. And you'll hear a lot from competitor BDMs on those months that happens. Just ask to see their 3-year rolling returns when they're showing you that information. Don't ask to see ours, ask to see theirs. They'll probably ask you what they are. What I want to do is now move on to trade. And this is a very important issue. And I'm going to start with a short video, and I'm going to bring President Trump back into the equation. So now let's start with a short video here.
China today accusing the United States of, quote, extreme pressure and blackmailing in response to President Trump's move to prepare new tariffs on $200 billion of Chinese exports to the United States. It's not blackmail, let's be clear. The Chinese state media can call it whatever they want. The truth is, China has a mathematics problem. The Chinese export more than 3 times as much to the United States as we export to China.
China has been taking out $500 billion a year out of our country and rebuilding China. But we have to do something about it. We're going to make it fair with other countries, both our friends and our enemies. And I have to say this, in many cases, our friends on trade have treated us much worse than our enemies.
Peter Navarro, top trade advisor to the president, director of the White House National Trade Council. And Peter, good to have you with us. Have the Chinese underestimated the president's resolve to move forward with tariffs to end China's predatory economic policies, in particular, predatory trade with the United States?
No, they certainly have. This man has the courage and the vision. This president has promised, going back to June of 2016, that he would use the Section 301 to crack down on China's unfair trade practices. He's doing exactly that. No one should be surprised. And Lou, the problem here is that China's targeted the crown jewels of American technology. They are using 4 attack vectors to go after it. They steal it. They force the transfer of it. They evade our export controls. And they're coming with trillions of dollars to places like Silicon Valley to buy it. And President Donald J. Trump says that's not going to happen on his watch. That's why he's put in tariffs, and that's why he's considering investment restrictions.
The last person you saw on that video was a man called Peter Navarro, who's the Director of Trade in the White House. Peter wrote a book back in 2011. He's written a few books, but his latest book in 2011 was titled Death by China. And Peter is a principal economic advisor, and there's a few others around the president, who is very, very hawkish on China at the moment. The president's not only picking fights with China, he's picked fights with many other nations. And he actually says in that video, if you listen to it, in many cases, his friends have treated America worse on trade than the enemies. And so who are these friends? They're allies of the United States, where unfortunately America's running a trade deficit with those allies. So they're countries like Germany, Japan, South Korea, and his North American partners, Canada and Mexico. In our view, this is just largely a domestic political issue. This is just playing to the Trump base sitting in the Midwest. This is about the auto workers who have lost their jobs. You know, trade deficits are bad. Trade is stealing your jobs. There is no strategic threat from these countries to the United States. There's no strategic threat in these trade deficits per se. And it's been our view that it's very likely that Trump will do deals with each of these countries. He will sell these deals as the greatest thing that's ever happened to these workers in the Midwest. He's actually done a deal with South Korea. A lot of that is focused on the auto industry, and he's done a fundamental deal apparently with his North American trading partners, Canada and Mexico. Of course, it's targeted autos again, and under the new, it's not called NAFTA anymore. It used to be the North American Free Trade Agreement. I'll come to the name because it's pretty important. but he's actually increased the labour cost requirement in autos that could be traded under the free trade zone. So American consumers are going to pay more for cars in the future in America. He has done something fundamental here, and it's important because he drove this part of it. He managed to change the name of the agreement. So it's no longer called NAFTA, North American Free Trade Agreement. It's called the United States-Mexico-Canada Agreement. It's got an acronym, the USMCA. I think the Village people are going to get to one of his rallies and are going to act it out for him. China, on the other hand, is a pretty different issue. Is it really about domestic politics? Is it really about trade deficits? In our view, there's something much more important going on with China than is going on with the other trade disputes, and that's why we separate these issues. At the core here is all about which country's going to come out on top in terms of manufacturing and technology in the future. It's just not about these domestic political issues that we're seeing with countries like Mexico and Canada. China is presenting a strategic threat to the dominance of the United States, and people around him, including people like Peter Navarro, but other very influential people, and I would say even people on the Democratic side of things, are now starting to realise that China has got some plans in place that are threatening the United States, and at the core of this is his Made in China 2025 plan. So what is this Made in China 2025 plan? It is an industrial policy of domination, and China wants to become the global manufacturing and technological leader in about 90% of the world's key sectors and industries in the future. It wants to reduce the external dependence on key technologies, key materials, key essential parts. It has gone out and effectively either borrowed or stolen this technology for its own economic development, and now it wants to internalise and not be dependent upon the Western world for many of these key materials. And in the plan, it talks about the full integration of military and civilian manufacturing. So when you read it, you go, and you can see the security hawks going, we don't really like what we're seeing. The question is this a relatively narrow policy, or is this a very broad policy? So what I'm going to show you is what are some of the industries, and this isn't all of them, but what are some of the industries that the plan actually mentions? Let's have a look at them. The breadth of this is staggering at the end of the day. This is state sponsorship to support and lead in these industries into the future. And if you look on this list, you can see things like robots, I can see rockets and satellites there. You can see in the technology sector, 3D printing, quantum computing, semiconductors. You get to aircraft and cruise ships, industrial software. I can see bioengineering up there. One that really got me when I looked through this list, in the centre there you can see deep sea space stations. What on earth is a deep sea space station? I guess if you're going to dominate space and rockets and satellites and you're going to dominate computing into the world's future and manufacturing, why not go underneath the oceans and make sure you're there first as well? You can see when the security advisors are looking at things like this and what China's saying, you can start to sense why there may be something more in this, as this is a strategic threat, than we're seeing in some of the other plans. So what is seeing in the other countries, in the other trade disputes? So what are the trade demands that the US has set out for China? Of course, they want a huge reduction in the trade deficit. They've nominated $200 billion. I think it started at 100. Trump didn't like small numbers, so he made it $200 billion by 2020. Of course, China will do a deal to buy more soybeans and more aircraft and things from America. They were very close to wanting to do that. And suddenly someone tapped Trump on the shoulder and said, no, this is a different issue. This just isn't Germany. We need to do something bigger than this. They really want protection about US technology and intellectual property. You know, China has been forcing the transfer of technology to companies that go and do business in China. And if they haven't been able to get the right technologies through that transfer of technology when you're doing there, they've frankly gone out and used cyber theft to go and steal blueprints and plans from many large multinationals around the world in key industries. They want restrictions on China's ability to invest in US-sensitive sectors. They want an equalisation of all tariffs in non-critical sectors. And of course, they want more access for American companies into the Chinese market. The question is, what's going to happen? And this is the big issue going on at the moment. Are we going to have a deal or no deal? Are we going to get to the point where Trump just does a deal, and this looks like what happened with Mexico and Canada? China, in our view, is very unlikely to make major concessions to its Made in China 2025 ambitions. Trump, on the other hand, believes he has the upper hand in these negotiations. He's very focused on the fact that the Chinese stock market has been a terrible performer this year. It's down 20 to 30%, depending on which index you look at in China. And he believes because the US runs a very large trade deficit, he can put more tariffs on Chinese goods and China can respond on American goods, that he can effectively put them into sort of a vice grip and force them into doing a deal. China, at the end of the day, is not a democracy. It can take the long-term view and it can wait the United States out on this. Trump can only be there for another 6 years, maybe 2, maybe 6, depending what happens in the next presidential elections in 2020. So is there going to be a deal? I think for a deal to be done is going to require Trump to take a step back, has to take a step back in really dealing with the core issues and do more of a cosmetic arrangement here. It's very likely, given Trump thinks he can apply more pressure, that the situation's going to get worse before we know whether the US backs off on what their demands are here. And the markets are being incredibly complacent about this risk. Even people like Warren Buffett and Jamie Dimon are saying, you don't need to worry about this. Trump will do a deal. He'll do a deal like he's done in South Korea and he's done with Mexico and Canada. I'm not so sure that reading of the situation is correct. I actually don't know whether he's going to do a deal or not going to do a deal, but I do sense we've got some more choppy waters ahead of us on this one. What I now want to move on to, and I've been talking about this for some time, and I think we're really getting to the apex of the issue, is monetary policy risk in the world. We're at an historical inflection point. This is an extraordinary circumstance in history we're living through. We've got some major colliding, huge macroeconomic facts coming together, and I think they're unprecedented in terms of modern history in sort of the last 60 years, if having a situation that looks today anything like it's looked like in the last 60 years. The question is, how's it going to play out? How's monetary policy and how are markets and interest rates going to play out over the next 12 to 18 months? I want to take you through what's going on, what are the facts we're looking at, and why are we cautious around this at the moment. The first fact, and I think most people understand this, is that asset prices in the world are elevated. We're not in a bubble, but we've got expensive markets around the world. If you look at the world MSCI price-earnings ratio at the moment, over the last 20 years, we're in the third quartile of that multiple. So we're not at the most expensive markets we've seen. That would have been sort of 1999, 2000 in this sort of 20-plus year period. The Shiller-Cape ratio does look like it's right at the top end of the range. I do think there's some faults in that. They're not adjusting history for the change in the nature of large business in the world. They tend to be much less capital intensive than they were in the past. These big technology companies really don't require a lot of capital and therefore intuitively should trade at higher price earnings multiples than things like banks and auto manufacturers and other large railway companies who went back a long time in history used to trade at. But even if I adjusted the Shiller ratio for the fact that the nature of large business is different, it would still be in a very elevated spot. And in the credit markets, investment grade and non-investment grade, we're in the third to fourth quartile in terms of the tightness of credit spreads that we're experiencing around the world. So that's fact one. I don't think anyone's at a surprise there. Don't believe everything you read in the paper about it being the complete bubble we're in. I don't think we're at that territory, but it's elevated and we know things are wound up at the moment. The second fact that's very important is the major central banks in the world are starting to go through a massive change in the amount of liquidity that they're providing to markets. So if we went back 12 months ago, the Bank of Japan and the ECB's QE programs were buying assets at the rate of $1.5 trillion a year. Those programs, well, not by the Bank of Japan, but by the ECB and the US Federal Reserve, are either winding back QE or starting quantitative tightening. The United States has started quantitative tightening. By the end of this month, it'll be running at a rate of about $50 billion a month. They'll be shrinking their balance sheet out. That's worth $600 billion a year by the end of this month. And the ECB started in the beginning of January halving their QE program from 60 billion euros down to 30 billion euros per month. By the end of this year, it will go to zero. That will take us at the end of this year on a monthly to annualised basis, annualised at 720 billion euros a year. It's $900 billion. That will completely neutralise all of the QE of, say, the Bank of Japan. And by the end of this year, we're going to be in a world where there is no net central bank support for markets around the world. That's a very different environment to what we've been in the last 8 years, and we would expect that bond yields and things will drift up during this period, and that's occurring at the moment. So that's a second important fact. The third important fact is where we bring Trump back into this debate and equation. What this chart is showing is the budget deficit in the United States as a percentage of GDP over the last 50 years. The three bars on the end of this chart is this year and the next 2 years, and you can see the budget deficit is increasing in the United States at the moment. And that is largely due to the Trump tax cuts that got enacted earlier this year. What I want to overlay is the unemployment rate in the United States over the last 50 years. And as you see that as the unemployment rate rises, the budget deficit rises. When it falls, you'll see it falling, budget deficit coming down. Then it rises, then it's falling with the budget deficit. It will go up when the budget deficit hits the unemployment rate. Up, down, up, again, down. And then there's something going on here. So let's just circle that. We now have the first time in modern history where we have the unemployment rate falling and the budget deficit rising in America. We've got a situation where the unemployment rate is now 3.7% in America, the lowest since 1969. Any measure of unemployment, we're not quite down to the lowest levels at the U6 measure, but it's fallen over 1% this year. We're right back sort of on a 20-year low on that measure. We've got a super strong economy in America, and now they're adding a very large fiscal stimulus at the end of an economic cycle. And that is really complicating the picture at the moment as what could it mean for monetary policy. So there's two principal scenarios we think could play out, the two main scenarios here. The first one, let's call it Goldilocks. And the Goldilocks scenario is we get no material increase in inflation in the United States over the next 12 months or so. We get no material wages growth. Believe it or not, there's only been 4 periods since 1950 in the United States where the unemployment rate has been below 4%. We have never seen a multi-year period with the unemployment rate being below 4% and inflation remaining at 2% or less. Yet that is exactly what the Federal Reserve is forecasting that is going to happen over the next few years. We're going to have a multi-year period with unemployment below 4% and inflation anchored at around 2%. If that happens, the Federal Reserve has forecasted very steadily rising US interest rates. They've indicated maybe another 4 rate rises through the next 12 months. That would take the overnight rates from about 2 to 2.25 to 3 to 3.25, and it'll probably push up the 10-year yield that's sitting at around 3.2 at the moment. It may push it up to around 4. I think that is a relatively easy market to think around. Rising interest rates are a headwind. It's probably going to support the strong US dollar. You'd probably want to stay away from emerging markets at the moment. You probably want to stay away from very yield-sensitive stocks as they get repriced, but I don't see that as a significant or disruptive scenario. And I think in this world, there are some very strong secular forces at work why inflation has been very low through this cycle and will probably in the long term continue to be low at a wages level. But this is a bet against history here, this very sort of non-disruptive situation that the markets are effectively backing, that the Fed is right on this at the moment. But let's look at scenario 2. Scenario 2 says that we actually get US inflation emerging over the next 12 months. And I'm really talking about wages inflation here. Average weekly wages are running at about 2.8 to 2.9% at the moment, risen marginally over the last year. But we actually find at some point these tax cuts start to bite, and as this economy is growing strongly, the labour market tightens to a point that we start to get some meaningful wages growth. And we're starting to see some evidence of companies really struggling on the labour front now in the United States. So there's some evidence that maybe the Fed isn't going to be right here, and this is really the case that the Phillips curve, which is the interrelationship between inflation and unemployment, isn't dead. We actually find out that history is right, and when you get a tight enough labour market, you start to get wages inflation. So what does that mean? We think that means that the Fed is wrong and their guidance is wrong under this scenario, and we could foresee materially higher interest rates in the United States. So instead of the rates going to 3 to 3.25, I think the market would say that the Fed is going to act, and they've said that if they're wrong, they're going to act with authority here. Jerome Powell's been very clear on that. So if they're wrong, the market would expect maybe another 3 or 4 rate rises. So maybe the overnight rate goes to 4 instead of 3, and long-term bond rates probably shoot right through 4. I think that could happen incredibly quickly. It would probably be on the second month that we found that average weekly wages were growing materially above 3. If that was to happen, a 20 to 30% stock market correction is entirely foreseeable. If that was to occur. Economists, of course, can't tell you that this is foreseeable at all at the moment, but they're very, very good after it happens of telling you exactly why it occurred. Will this happen? Won't that happen? I put about a 50% probability, given the environment and these tax cuts and how wound up these markets are, that we get this happening. That's about the same probability I'll put on the Goldilocks scenario that the Fed's backing. It's a very polite way of saying I have no idea which one's going to happen here. But it's a very important point to understand is I'm not talking about a 1 or 2% probability. This isn't a remote case. Whether it's 30% or it's 40%, it's 50 or it's 60% is a little bit beside the point. The fact is the risk is elevated at the moment and the consequence is entirely foreseeable if it was to occur. So what are we doing about this at the moment? Not surprisingly, in the short term, we are cautious around all of this. We're cautious about trade and we're cautious about the Fed getting caught out on this monetary policy in the next 12 months. We're holding 18% cash. We can go to 20% cash in the global equity strategy. So for all intents and purposes, we're pretty much holding our maximum cash position. And we've deliberately at the moment, at this point, had low exposure to emerging markets and to China. If we start taking a longer term perspective here, the first thing I've been talking about a number of years, we've got a lot of significant shifts happening in the world and we don't want to get caught in the next newspaper industry here. So we want to be in businesses that we think over the next 10 years, from what we can see today, they're very unlikely to be disrupted. A business we've held for a very long period of time is McDonald's, reported overnight, had strong results. Again, overnight, share price up 6%. Overnight, not that we get caught up with overnight moves at all, but we think it's very unlikely that Amazon's going to get in the hamburger business. We could be wrong on that. Bezos seems to get in everything these days. We don't think the nature of those businesses and the way they get distributed is going to be fundamentally changed. They may get delivered with a Grubhub or something in the future, but the physical nature of how they get produced and the consumer's desire for these products is probably not going to change. We've got a healthcare trend that's been on for a very long period of time, and we don't see that fundamentally changing there. The second part of the long-term positioning that I think is incredibly important, if you want to make a lot of money over the long term, you need to invest in businesses that return high compound interest to you. It's the magic of compound interest that really works for you in this business. And therefore you want to invest in businesses that the winds are blowing in your direction. You do not want to be going into deep value headwinds. That is a seriously tough way to make money over time. So examples of what we've been doing is businesses like Visa and MasterCard that we've held probably for 8 years, a massive secular tailwind behind their businesses, the conversion out of check and cash into forms of digital payments in the world. Of course, we've made a rotation to technology, but it's not all about tech stocks like Facebook or Alphabet or Microsoft, which has been terrific for us. It's also businesses like Yum Brands, which we've held for 11 years, and a new business we've gone in with Starbucks. I'm going to give you two very quick case studies. One on Starbucks, because I think it's very interesting, because it's not a tech business, but it's something we're really looking at a decade into the future. And then also Alphabet. There's a lot of discussions around tech sort of being in a bubble at the moment. So I'll take you through our largest holding in a moment. Starbucks. What is Starbucks? According to Starbucks, they're the world's leading specialty coffee business. Frank Casarotti has asked me to take the word specialty out of that description. I'm not going to tell you what he says about their coffee there, but it's an iconic brand. It is a global business. 29,000 stores in 77 countries, 95 million weekly transactions, 35 billion in total system sales, and it's got a market cap around 74 billion. So you'd ask the question is, what are we doing investing in what looks like a large, mature takeout coffee business at the moment? Where is this tailwind behind this business? It's got three very large businesses there. One is its US business, which is currently around 65% of its earnings, 14,000 plus stores in the United States. Slowed down somewhat. Its comps were a year ago at about 5%, they're now down to about 2% in the United States. We're not overly worried about that in the United States. It's a very, very good business that's going through a slightly slower sales growth period, and its long-term store rollout will slow somewhat, but we understand that in its economics. China is only around 12% of its business today. It's got 3,400 stores. It's been there for 20 years. I want to talk about China. It's incredibly important. And channel development is their beans and pods business, and also selling coffee through food service to hotels in the world. They've recently done a deal with Nestle. Nestle paid them just over $7 billion to do a global alliance. That is largely a US business at the moment. Nestle wants to take that business totally global, to sell its beans and pods through its Nespresso and through its distribution outlets, and take it through the food service channel globally. The future and the driver of this tailwind of Starbucks is actually all about China. Starbucks China, this is just a massive opportunity, a relatively small business at the moment, 12%. This is very similar to 11 or 12 years ago when we invested in Yum Brands, where China was relatively small. KFC in America was facing headwinds far more severe than the headwinds that Starbucks is facing in the United States of America, and no one could get their mind around it. And we're saying, but look into 10 years in the future, how big China will become. China is a massive opportunity for Starbucks. This is a McKinsey analysis, doubling the middle class, 300 to 600 million consumers in the next 5 years. Whether it happens in 5 years or 8 years, it doesn't really matter, but we can see the rise of China and the income of China and the consumer class. And the second part is when we look at coffee consumption in China, Americans consume over 300 cups of coffee per year. I suspect Australians consume above. I don't have the stats, but I think we consume above the Americans in our coffee habits. China is less than 1 cup per day. And the great thing about coffee is that it's addictive. So once you get these people trialling this product, it's very likely they're going to continue to consume it. What is Starbucks planning in the next 5 years alone in China? They're planning to enter another 90 cities in China by 2022. And when they say a city, they mean somewhere with at least 1 million people in it. So these are large towns at the end of the day, by our definitions, and they're rolling out 600 stores per year into China. So they're probably going to be about 6,000 stores in 5 years' time. That's nearly 2 stores per day they're rolling out in China. And we ask ourselves as in question, as investors, is this a sensible thing to be doing, spending all this money to roll out in new stores, and particularly smaller cities in China? So if we look at the economics, in the big cities, which is a middle column here, in say a city like Beijing, when they open a new store, in the first year they get sales of about $700,000 a year. And given the cash they put in to build the store and fit it out, compared to the first year cash flow before tax, they get about an 85% return on their capital. And in the smaller cities, they're getting returns around 87% at the moment. There are very, very few places in the world where you can put your money to work at 80% return pre-tax in the first year. If you know about them, please come and see me after. I'd love to know them, as long as they can be scaled and they're large. I don't want to hear about your grandmother's coffee shop somewhere. So this is an extraordinary, compelling case of the economics at work here. What would this translate into over a decade? So this is our view of a decade. In a decade, they may have 11,000 stores in China at this rate of rollout. We think they could grow their revenues between 14 and 17% per annum in China, with ridiculous returns on capital. And actually, given the scale of the opportunity, this could well go for another decade beyond the decade ahead of us. What would that translate into overall for Starbucks? That could drive 7 to 10% net profit after tax growth. The top of this column is actually our base case, and the lower case is a lower case with less sort of penetration around the world in terms of the economics of their business. And believe it or not, even though China is only 12% today, it is driving 50% of the profit growth for the next decade in China. How could this translate into as investors here? This profit after tax growth, net income growth of 7 to 10%. They do buybacks each year out of the cash flow they're generating, another 3%, which would increase the earnings per share to maybe 10 to 13%. The dividend yields around 3%, which means they can maybe up to for a decade, produce mid-teens returns to shareholders in terms of earnings per share growth and dividends growth, or dividend distribution back to you over the next decade. And we're paying around 21 times earnings for this at the moment. We think the valuation is compelling. This is a much lower multiple that Starbucks has literally ever traded at in the past, other than in 2009 when markets collapsed. Now I want to move on to Alphabet, and this is important. It's the largest investment we have in our global equity strategy, and there is a lot of talk in the media and by other people about all FANG is in a bubble, tech's in a bubble. I want to outline why we think Alphabet is compelling at the moment. I have got no idea where the Alphabet share price will be in 3 or 6 months' time. That will largely depend on market sentiment. We have a pretty strong view of where this share price is headed over sort of 5 years over time. So let's start with the core of their business, which is an advertising business, the Google business within Alphabet. They've got a global market share of 20%, and it's growing at around 20% plus per annum at the moment. And the law of large numbers, they've got $100 billion of advertising revenue. You'd assume that this rate of growth is going to slow down. The question is, how mature is their advertising business today? This is one hell of a business, this advertising business of Google's. The first of all, I would argue that there is 2 massive markets available for Google that have not really been tapped by them. The first is what we call and they call local-based advertising. So what they're trying to do is they're trying to connect you, and believe it or not, they know where you are at any point in time if you carry a phone and you use any Google services. Unless you're sophisticated and you can turn it all off, they know where you are. And if you use any apps that link into it, they know everything about that's happened on the apps, and they know everything that's happened, anything you've done on Google, on search, or on Maps, or on YouTube, or on Gmail. They know all that about you. And what they're trying to link is opportunities between they know about you and the environment that you're in. Who's heard of Google Lens here? Can we just have a show of hands? I'm just going to have a quick look around. 1, 2, 3, 4. I may have had 5, 6, 7 hands. 1% of the audience have heard of Google Lens. Google Lens is an incredible product that they're integrating into Google Photos, and if you're on Android Photos, available as a separate app, you could go into the Art Gallery of New South Wales and take a photograph today of a picture on a wall. And then you go into your Google Photos app, and there's a little circle, and that's a lens button, and when you're on the photo, click on it. It will scan its database, and it will find literally any painting in the world in any art gallery, and it will tell you exactly what that painting is, the history about that, the history about the artist, etc. They're also wanting to elevate a new thing you can do with Lens if you're on a Pixel phone, is you can walk up to, say, a lady and take a photograph of her. It will search the database and it will tell you what dress she's got on, and it's trying to link up to make sure it can tell you whether that dress is available in a shop nearby you, or if somebody else by that designer is available nearby you. So this is really what they're trying to link up. It's kind of the holy grail for advertisers in the world, connecting all this information about your location and who you are with the environment you're in. The second one is the advertising, the video advertising, television advertising in the world. They've got a business called YouTube. You may have heard of it, particularly if you've got younger kids. The television advertising market outside of China is worth around $200 billion a year. At the moment, most of that advertising is still on traditional forms of television. That is an industry that is ripe for disruption and is about to collapse in our opinion. And the reason is because of the rise of these streaming services, Netflix, Amazon Prime, YouTube, and others. What they're doing is they're stealing the viewership from traditional forms of television and pay television in the world. And as more and more viewers get stolen, in the end, advertisers will pay less per impression that they're getting on television, which is logical. But the problem is these streaming services are bidding up the content costs, 6 to 8% a year. When your expenses are going up and your revenues are going down, that is not going to end well. So if you want to go and invest in some of the television companies here, or you could short them, that may be a good idea. But you know, it's not something I would suggest unless you want to learn something. It could be a very good education over time. So what is YouTube? It's a massive platform, 1.9 billion monthly users, 1 billion hours are watched every single day. The average use time of a video is 40 minutes when people are viewing there. And the unique thing about these new streaming services, every single person can be targeted a different ad. Television is linear, everybody gets the same ad at the same time. On these news services, everybody gets a different ad. And as this collapse, businesses like YouTube, we think will be massive beneficiaries. If you think about what happened in the collapse of print advertising in the world, around 85% of that revenue ended up outside of China with 2 companies, Facebook and Google. If Google via YouTube was to get 20% of television advertising in the world as this industry gets disrupted, that's $40 billion a year in revenue to Alphabet. So no, we don't think this is mature yet. But it's not all about advertising. They actually have some massive other businesses that yet haven't been turned profitable, but they are massive businesses of the future. The first of these is a Google Cloud platform, and the second one is their autonomous driving software, a business called Waymo. So if we have a very quick look at the Google Cloud platform, outside of China, there are 3 large players in this game. They happen to be Amazon through Amazon Web Services, Microsoft that owns the Azure platform, and Google Cloud Platform, obviously owned by Alphabet or Google. We think the total addressable market for the shifting of computer infrastructure away from business or enterprise in the world into data centres in the cloud effectively is maybe an $800 billion a year market if we look over time. So an absolutely massive market. This is a hyperscale game. You need tens of billions of dollars of investment every single year into it. You need massive data centres, you need undersea optical fibre cables, and you need an enormous amount of technology to power this. We don't think there are going to be new players getting in this game. If Google was to get 20% market share of this business in a decade, that business may be worth in revenues $160 billion a year. That's bigger than the whole of Alphabet is today. Very hard to know exactly how those market shares will play out over time, but we do know that these are the 3 strategically advantaged players. And Amazon Web Services, which was a genius move by Jeff Bezos to get into this business, underneath the radar of other people is already hugely valuable within the Amazon share price today. What I want to do is briefly update you about where Waymo is. I'm going to start with a very short video, and then I'm going to wrap that up and I'm going to bring the guest on stage. So let's start with this short video on Waymo.
Cars are here.
We've been waiting for this moment, and now it's become reality. Fully self-driving cars.
Waymo is the self-driving arm of Google's parent company Alphabet.
Yeah, there are new developments this morning with Waymo. They just announced they are rolling out even more of those autonomous cars.
They have several hundred Waymo minivans, and they will soon have an autonomous rideshare program that will be announced by Waymo a little bit later on this year.
In the last 8 years, Waymo's vehicles have driven more than 5.5 million autonomous kilometers on public roads. Right now, we're driving about 16,000 kilometers every day on public roads and driving another 16 million kilometers each day in simulation.
You could soon be driving next to a Waymo vehicle. The company announcing they're purchasing nearly 65,000 vans.
Everything is designed and built for full autonomy. We outfitted our cars with an array of hardware, including a powerful AI compute platform, along with lasers, camera, and radar. With the world's first fleet of fully self-driving vehicles now test driving on public roads, this is a future we can all begin to imagine.
What they were talking about there was the first stage of the commercialisation of Waymo, and that is a fleet of fully autonomous cars, a taxi fleet with no drivers, called up by your Uber app, effectively. It would be called the Waymo app. And what they're starting in Phoenix in Arizona, they've been running a test pilot program with 400 people who signed up to it. The end of this year or the beginning of next year, they're going to open up that service to anyone in Phoenix in Arizona. They have already ordered 20,000 Jaguars and 60,000 Chryslers to be fitted out into their autonomous fleet. Those cars can do up to 4 million trips a day. That, if they were going to get $10 a trip, maybe $16 billion in initial revenue, and this is the first stage. Then they will ultimately roll out these fleets as they start getting approved around the world to do this. There's going to be an arms race with people trying to do this. We are not going to have 50 of these fleets happening in the world. And then ultimately they'll license their technology to other car manufacturers and auto manufacturers and trucks and things. And maybe we get personalised autonomous cars. I don't think that's coming for some point in time. But if you look at the net present value of the value of this software, it's going to be enormous over time. So what do we really think about Alphabet at the moment? At the moment, the S&P 500 is trading at around 16 times 1 year forward earnings. If we look at Alphabet, it's trading at sort of 21.5 times forward earnings. Does that look expensive at the moment for a company that's growing above 20% per annum? At the moment? Well, we think if you start to do some adjustments, it's even more compelling. If we strip out the cash in Alphabet, it's about $100 billion of cash, and we take out the interest income, and we impute a value for these two large businesses, Waymo and Google Cloud Compute. There are estimates of people who put up to $200 billion on Waymo alone. I'm putting $100 billion on the Google Cloud Platform, which we do DCFs, and that looks like a conservative number, and Waymo together. But call it 70 billion or 120 billion. It doesn't matter in the scale of this. But you make those two simple adjustments and you say, what are you getting for the core Alphabet business at the moment? How much are you paying? You're paying 15.5 times for the world's best advertising business that's growing above 20% a year at the moment. This is the world's most strategically advantaged company on the planet, trading at 15.5 times earnings at the moment. So no, we don't think that's in a bubble. I think they're telling me to get off here, which I will do because they're switching it on and off. You know something about. Next I'll have my security pass taken. Brett, thank you. I wrote in the investor letter this year a theme at the beginning, Conservative Investors Sleep Well, which was a book actually written by Phil Fisher in the 1930s. At the end of the day, we are very focused on our investment objectives, get people a decent rate of return on their capital, and don't lose people's money. At the end of the day, we're incredibly focused on that downside protection. We will never swing for the fences. We'll only invest in a portfolio of companies that is very high quality in what we do. What I'm